Welcome back to Turning Hard Times into Good Times. I'm your host, Jay Taylor, and I'm really pleased to have with me again, almost every week at least, David Jensen. Welcome, David. Good to have you back.
Good morning, Jay.
Really always good to talk to you for your perspective on the markets. And you've been pointing out to me and to my listeners every week that we've had this premia in the various metals. The smallest one being in gold, which is the largest of the precious metals markets. But there's a rising premia in silver that's quite large now. It's getting quite large. And the biggest ones are in palladium and platinum. Palladium being, you point out this morning, something like a 16.4% premia, which means that people are paying that much more for physical delivery of palladium than what we're seeing in the futures markets. Do I have that right?
Yeah, that's right, Jay. The Shanghai Gold Exchange premia that are being generated are indicating that there's $145 per ounce more being paid for palladium in Shanghai than in London, which is the benchmark, the LPPM, London Platinum and Palladium market, which is the benchmark for that. And then also, as you mentioned, silver, 8.1% premium in Shanghai versus London. So it's indicating a disparity of pricing, and knowing that the Shanghai Gold Exchange price is for the physical metal, and that London really represents a paper market. It's indicating that maybe we can summarize it as a false supply of metal in London through paper volume of trading and availability of positions.
Mm-hmm. And you noted to me also that there's something going on in Moscow now. There's a new Moscow exchange that is largely a physical market as well for the precious metals?
The Moscow exchange opened up in the fall of 2013. I think it was November of 2013 to trade gold and silver, and they offer an unallocated account, but you can settle for physical. So it's with a note of caution. But it is interesting there as well that we're seeing now a $210 per ounce premium for gold there, which is about 16.4% versus London, and about a $3.20 per ounce premium for silver, which is also about 16.4% versus London. So, and then also a note that London, Shanghai, and Moscow charge a VAT on the purchase of metals. So we're dealing with apples, and apples really, except for gold, which in Shanghai and London, they don't charge a VAT for the purchase of those. But the demand, or the supply, pardon me, for the metals to these markets comes globally. It doesn't just come from other exchanges. There's very large holdings in Switzerland and other places. Suspicion of leasing by the ETFs as well, that has to be confirmed. But the draw is a global draw to these markets, and the sustained premiums for real metal in Shanghai is indicating that there's something unusual going on in the markets there versus the London paper markets.
Because you're saying again, there's no value-added tax. You said in London and China. Is that what you said?
For gold.
For gold. Okay.
Yeah, but silver, platinum, and palladium do have a VAT tax applied. But again, the supply into Shanghai is not strictly from the London Exchange. Only 35% of the Chinese supply of palladium to the market actually registered as imported palladium. I suspect that the delta, the 65%, is being made up by smuggling, or maybe even more likely from actual scrap recycling and importing scrap and processing it and extracting the palladium from that. So there's many sources of palladium into that market, and we can't ascribe the delta, the higher price for physical in Shanghai due to the VAT taxing on top of the London price, which is paid. So, I think there's something going on in the physical markets, and that these sustained elevated prices are not being extinguished. And I think that they're showing the difference between a real market, which is unfortunately in Shanghai but not in the West, manifesting itself.
Well, you noted that in silver there's really some really big things going on there. There's a predicted deficit, huge deficit of in 2014. Could you talk about that a bit?
Yeah, before the year started, the estimate was about 113 million ounce deficit. We know that there's about 1.4 billion ounces in above ground refined stockpiles, and that would include ETFs, Swiss vaults, etc. The daily trading in London is 1.63 billion ounces, and to get a sense of the London market, if we use a 2 times multiplier of that daily volume to estimate the open interest or the open positions, we would get 3.3 billion ounces of open interest in silver in London. Or if we used a 3 to 1 multiplier, then we end up with almost 5 billion ounces of open interest. So, that's a real indicator. There's a benchmark for the disparity between the volume of silver, which is traded in London, and the actual availability, the above-ground availability of the metal itself. So what it gives, Jay, maybe in summary, is it gives London gives a false indicator of the availability of metal, because they make metal available through paper positions, not through metal itself.
Yeah.
And so this additional supply, quote unquote, to the market forces the price down. And it happens through both the rapid sell downs, which the bullion banks execute to take out the trading stops, and it occurs in the overall open interest, which is there. And what we're going to see then is we expect to see is shortage of metal globally because of this false paper supply and a malpricing, an artificially low price for metals. And this ultimately will lead to a migration from paper into the physical market, and much, much higher prices for the physical metal. It'll be, just get the metal. What do you have the metal will be the question, because there will be a growing understanding of the falsity of the trading instruments which are being traded in London.
So let me understand for sure what you're saying here. You're saying that there's this huge open long position for silver, and that if a large number of those people, or a growing number of those people, want to actually take physical delivery instead of settling in paper, then there's going to be a rush through a very narrow door for the supply of that, which could push the price of silver much, much higher.
Yeah, and that will be inevitable, because what is happening with London, it's a form of price control. When you provide supply which is not actually there, you artificially offer too low a price for the metal itself. And we know with price controls you end up with empty shelves. The price is not adequate to draw enough supply into the market, both through production and existing above ground stockpiles. So it's not if, it will happen because of the shortage which is created by price control, which is really affected by this false supply of paper metal to the market, which is not real.
Yeah, it seems to me fraud is the only word that comes to mind for that kind of behavior. You also mentioned that trading on the LBMA, 85% of global daily gold volume is on the LBMA.
Yes.
But go ahead and talk to that point.
Yeah, it indicates the power of the LBMA and really how dominant a market that is for the precious metals. And I would say, by looking at the volume in silver, that I would expect that even more of the daily silver trading would be on the LBMA. That was not specified, but that number comes from the LBMA's own research paper in 2011. And it was called Local London Liquidity Survey Q1 2011, and maybe we can supply a link in the show notes if that's possible to that survey. Mm-hmm. But that survey was the root of Goldcore. That's GOLDCORE.com, not Gold Corp, but Goldcore's paper of 2013. Beyond the Smoke and Mirrors, and it looked at the LBMA trading volume that was happening there. So it's, when they post their daily gross trading or net trading volumes, it's actually 10 times higher than that in terms of total volume that's flowing through there. And a couple of interesting notes from that liquidity survey by the LBMA was that they represent 90%. 90% of the trading there was in the spot market. 5% was in forward instruments, and 5% was in quote unquote other instruments. So 90% of that enormous volume that you see trading on the LBMA each day is directly impacting the gold price by setting the spot market price. So there's more evidence that the LBMA is a dominant pricing power in the quote-unquote physical market, which is really, as we see, really not physical itself, but it's levered paper instruments through which they create a false supply of the metal itself.
A false supply of the image of the metal itself, not really the metal itself, right? So it's it's a falsehood, essentially. I mean, it just seems incredible. First of all, this huge paper volume, which is far, far greater than any physical delivery, and then you have 90% of that is daily trading. It's just incredible. The massive amount of paper that has hit the market that pushes the price of gold down. God only knows where the price of gold and these other metals would be if it weren't for this kind of fraudulent behavior on the part of the players. You talk about Moscow and Shanghai exchanges showing materially different prices for the metals. Could you talk a little bit more about that?
Yeah, it's just the fact that we expect to see markets where you can secure metal and where there's real demand for the metal to show a price differential to the paper markets, which are being subverted by the supply of paper giving a lower price. So seeing Shanghai with the greatest premium in palladium, that's exactly what we'd expect to see, because palladium is the metal for which there is the greatest shortfall this year, and Standard Bank has estimated a deficit this year of about 25% of the total demand in the market will have to be made up by withdrawal of the metal from stockpiles. There's a 25% or 2 million ounce deficit in the market. So, and the other physical exchanges that are coming on are going to provide other benchmarks for us too, Jay. Singapore is coming online in September with a new 25 kilogram or 803 ounce physically settled contract. And that contract is only settled in metal. There's no paper settlement. So that'll be an important reference point for us. And also, as we've talked about in the past, the Shanghai Free Trade Zone, which will open up gold trading for foreigners in Shanghai, is coming on September 26th. So we will have, the Shanghai Free Trade Zone, the Shanghai Gold Exchange, and the Metals Exchange. We will have Moscow. We will have Singapore as key benchmarks that we can follow and track this, what I think is an expected price increase for physical metal versus the London paper markets and the New York paper markets, which we see New York is really a sideshow.
Yeah, it's a sideshow. I think you're right about that, but clearly it's the sideshow that our mainstream media focuses on, and they drum into us the notion that is the real market is the LBMA and the U.S. the COMEX.
Yeah.
So,
Yeah.
I mean, the question that I would have for you, David, is what will change that?
Well, what will change it is the realization of individuals, market players, interested parties who need the metal. They are going to be confronted with physical shortage driven by the existence of these paper markets, and that will cause an accelerating move to secure the physical as they realize that their positions in London and New York are really not tenable and not really of value. So I would expect to see a migration into physical metal and with a growing understanding of the fact that you just can't get the metal and in most markets in the world, and that perhaps sitting comfortably in a paper position thinking that you're in the metal is not the best place to be.
Yeah, though, I hear what you're saying and I agree with what you're saying. At the same time, though, as I look at the screen, I see that the equity markets in the U.S. are making all-time highs. Even though the equity markets are going up, the bond market, the U.S. Treasury market looks strong today. At least it was earlier today when I looked at it. So, I mean, to most Americans, they're saying, yeah, it's rubbish. I mean, really, I like my stocks. They're going up. I'm getting wealthier and wealthier, but obviously there's going to be some change along the way, I think, that's going to change all that. I suppose. I don't know if it's if it's some sort of inflationary. Some inflation that causes people to wake up and realize the dollar isn't all it's cracked up to be, and people start to exit the dollar. Clearly, I think the policymakers are doing all they can to try to keep people conned into accepting the dollar, and they've been very successful for a long period of time, with a few exceptions along the way, of course. But as you've noted, you sent a very interesting, provocative idea to me that having to do with global reserve currencies. You say that the dollar really isn't the reserve currency. Explain that one.
Well, if we look back historically, on a series of reserve currencies, whether it's the British pound or the sovereign, the U.S. dollar, the Portuguese currencies, etc., the Spanish mil dollar, they basically attained their status because they were interchangeable with the metal. Mm-hmm. And so, I mean, the paper currency name has really just been the trade name for the metal itself, but it is always the reserve or the dominant exchange currency, global exchange currency. They've always started their life as metal. And then with time, there's either been a shortage of metal and they lost their status, or a series of defaults. The UK defaults on gold interchangeability in the 30s, and the United States defaulted in 1971. So the concept here is that if you want to have a global reserve currency, you've really got to have the metal, and you've got to have liquid metal to back it. And so it's not really a global reserve currency, it's that you have gold or silver, and therefore you are able to provide that facility.
Yeah, so that's, interestingly enough, the countries that are looking to set up their own financial system, the BRIC countries, for example, that are looking to compete with the United States, are, by all accounts, accumulating huge amounts of gold and silver. Yeah. And I think lost on the public, and not only just the public, but I think the PhDs in economics from Harvard, Princeton, and Yale, is exactly the truth that you just laid out, that historically that's the way it's done. I guess they think that, as James Grant says, the PhD standard is better than the gold standard, and they're setting out to try to prove it. But all I can see is that more and more troubles on the horizon for our economy, because debt is growing so much more rapidly than income. It seems to me, David, we're going to have some sort of a day of reckoning here, and I know people that have been listening to Gold Bugs warn about this for several decades now are saying, yeah, I hear what you're saying, Taylor, but you've been preaching this same sermon for 30 years. What do you say to those kind of people?
Well, I mean, what do you say to them? We can see the situation that we're in. The central banks have entered the markets, have printed money, have bought $29 billion of financial instruments, including stocks, to artificially buoy the markets. And I guess the real question is, what do you say to that? Talking to them, because they've got zero interest rates, which indicates a failure of monetary policy, and they are basically up against the wall here. Yeah. So we can see through centuries of data the stability of metals, of gold and silver in particular, as the market choice for exchange media. So the question is, given where you're at right now, and given the previous history of stability, how can you justify the fact that you have the right to print as much money and wealth as you want? You have the ability to bail out banks, really providing gambling insurance for the banks when they blow bubbles which collapse, and that it's a good thing to have inflationary monetary policy which destroys savings and drives the cost of the necessities of life ultimately through the roof.
Yeah, well, I think you're right. I know you're right, David, and I guess the main thing is that people, we tend to believe the things we've experienced most recently. And I think what you provide for this show, and a lot of my guests do, our good friend Ian Gordon certainly does as well, provides a historical view of markets and so forth. And history is something that our educational system doesn't teach anymore either, very much, if at all. So I think it really does pay to look in the rear view mirror sometimes, longer term, and see what actually happens when you start to debase your currency, as we have Just one other note before I let you go here, talking about interest rates. You just touched on it a little bit. Would like to get your view on what is the impact of rising interest rates, assuming one day people start losing confidence in the dollar and start, let's say, getting out of the dollar and going into tangibles. What's going to be the impact on gold? Because the general consensus and what you hear from the mainstream is, if the interest rates rise, that's going to be gold's death knell.
Yeah, but rising rates cause a declining bond market, and the global debt markets are over $200 trillion. So rising rates is going to cause a decline in those values. And I think what we're basically going to see is rising prices of all goods, including gold first, which is going to impact interest rates. And I suspect all this talk about raising rates sooner than later is the Fed and other central banks trying to contain interest in alternative investments, such as physical investments, such as gold, silver, oil, etc. But the rates rise basically. What we know from Gibson's paradox is that they rise in response to the gold price, and they're really printing almost an infinite amount of money right now, and it's inevitable that the price of real goods is going to rise. And so what we will see is a falling bond market, a rising interest rate, along with a rising gold price as gold goes higher. They're going to reach the point where they lose control because they have just abused the ability to print money so much that it's inevitable that those currencies lose their value.
David, do you think that it's the real rates of interest? I mean, I remember the 70s very, very well, in which the interest rates were rising, but inflation was rising even faster. Is that what you see here?
Yeah, I mean, the inflation was running about, I think, around 12-13% in 1980, and interest rates rose to about 18%. That's how much higher they had to go to arrest the price of gold.
Right.
So, we've got, John Williams' work using, their own measure from 1980, the BLS, pre-adjusted consumer price index numbers. I mean, we're around 8% right now. So, if you want to add 5 or 6% to that, above that to arrest a rising gold price. But you see, the issue here is that the price of gold is being set by paper trading, and they were fighting a real gold price back then.
Yeah.
What they're doing now is they're giving us an artificial gold price, and what they're going to lead to is basically the metals market lockup. And then you're going to have a sudden change in interest rates. And that's the problem, is that they won't let the price of metals rise. They won't allow the credit markets to function properly. They won't allow clearing of bad debt. They're painting a false picture, and this is what the problem is that they're pushing towards market lockup as opposed to letting these markets function and clear. Right.
And the results could very well be, unfortunately, cataclysmic in many ways, I'm afraid, because the failure to allow the markets to work. How could it happen in America? America was supposed to be the leading country of free markets and freedom and liberty, and quite the contrary seems to be unfolding. And really, I don't think it will be, the general public will really understand the connection here. I don't know, I hope they will one day understand the connection between their loss of liberty and these kind of monetary policies that are being put into place, because there's no doubt in my mind, David, and I'm sure you'd agree, that that there is all the connection in the world between the two.
Yeah, when you have central planning of currency and interest rates, you have central planning of your entire economy, and that's not the definition of a market economy, and it's not the definition of liberty from anybody's understanding, which I think is grounded in reality.
Well, it's the definition of fascism and communism, which I thought we were supposed to have gone to world wars to eradicate, or to make the world safe for democracy, which of course I think was another whole story that probably was another falsehood, like a lot of the others that we get from our mainstream media and the propaganda machine. Well, that's about all the time we have today, David, but I want to thank you again for sharing your insights, very valuable insights, I think, to help our listeners understand what is coming our way and how they need to prepare as best they can to to save their families from the destruction that might be coming our way. So thank you very much, David, for being with us.
Thank you, Jay.